Those buy now, pay later plans can cause serious damage to your debt to income ratio. Another piece of the financial puzzle is the debt to income ratio, right? That's simply the lender's going to look at your total monthly debts. They're going to divide that by your gross monthly income, and that's going to give them a ratio. Typically, with most loan programs, they want you to be under about a 45 to 50% debt to income ratio to qualify. And what usually hurts people in this situation is people got big car payments, man. I've ran into people that got car payments that are, 1,200 a month, 1,500 a month, and things like that can drastically impact your buying power in the market. Like, depending on what your income is, a car payment of $500 can reduce your buying power by as much as $80,000. So think about that. Buying a $300,000 house versus buying a $380,000 house. Those are two different houses. So again, just pay attention to that. And if you don't have to take out a large car payment, please wait till after you buy your home to get that car payment. But those buy now, pay later plans can cause serious damage to your debt to income ratio. One time I had a client that when we started the process and we pulled the credit, she had over 10 active accounts at the same time, which almost killed her from qualifying. Luckily, she was in a situation where she had some funds set aside where she was able to pay those off. But if she couldn't have paid those off, we weren't going to be able to move forward. So again, I want you to avoid those at all costs, but really avoid them as you start the process to get ready to buy a home. If you have them out there that are active now, do what you can to get those paid off because they have a big impact on your debt to income, and I don't want that to hinder you from moving forward. Now, if you have them out there and they're deferred, the big issue with a student loan that's deferred is the lender's going to take the total student loan balance, going to take 1% of that balance, and they'll count that towards your debt to income. So if you got large student loans, that can really hurt you. So it's very critical that you get on an income-based repayment plan so that we can get the lowest payment possible so that it won't impact your debt to income. So again, we can talk about that on a case-by-case situation if you have it, but I just want you to be aware. Payment history is the most important thing. So again, make sure do everything in your power to make sure you don't have any late payments. That means letting something go past 30 days late before you pay. Put it on auto pay, do whatever you can, but no late payments because a late payment will literally set your clock back another 12 months before you can start the process with the lender. So no late payments.